A bit from now. Venugopal Garre is joining us now. He's Managing Director at Bernstein. Venu, great to have you with us here. Thank you very much for your time. It's always a pleasure. A couple of very interesting reports are coming through from you over the last couple of months or so, Venu. Let me just start, though, by putting into context your thoughts on where we are on markets and how you're feeling about it. I just put out a chart basically showing P multiples on the mid-cap index now versus previous significant highs. Back in October of 21, when that index peaked out, the mid-cap index was trading at some 33 times earnings. We're at about 23 times 1 year forward. Bloomberg consensus numbers. So it doesn't look crazy high. We've been higher, much higher still. Your thoughts, just to put into perspective.
Thanks, Prashant. So I would probably say that on the first thing is, I think I'm still positive on the markets. When I say positive on the markets, my view hasn't really changed with respect to downside risks. So positive primarily from here means that there are limited downside risks. So our broader thesis when we upgraded the markets in early April was that they would broadly be a broad-based rally, which primarily meant that both large caps and small caps should do well. Thereafter, about a month or two back, when index crossed 19,000, which is nifty, which is when we started to probably start talking about the fact that we want to be more in mid caps than large caps, with a view that large caps have more or less sort of reached sort of a fair value. That was a broad thinking from a rotation point of view. And the argument that we made at that point of time is very similar to what you're saying right now, is the fact that mid cap valuation relative to large caps, there was still a large gap in the sense that they had not peaked yet. So the reality is they have not peaked yet. But what is going to happen from here, in my view, is that even if I take a broadly positive construct in the market, for me, the next touch point is broadly elections. So until then the small cap, a lot of large, relevant, good quality stocks have actually moved quite tremendously. So what is happening now is you would see rotation into low quality. Low quality is defined by a lot of factors, by the way, but then the perspective is when you start to see this low quality move up fairly quickly, which is when you would start to worry about small cap overall peaking off. Now, at this juncture, when I think about it, if I take the positive view, then large caps are starting to look like, relatively attractive again. I mean, if you were to think of some of the large caps which haven't moved, as much yet. So maybe you see some rotation in that later in the year back into large caps.
No, so Venu, sorry, you're saying that a late stage movement to low quality started, or it will start at some point? It's already happening.
Some of it has already started, but you tend to see a peaking when a lot of low quality would have moved up. Okay? So we haven't yet seen every low quality stock move up, right? Quite a few of them have just started moving up. Now, we're still some time away from that situation where almost everything in mid cap, irrespective of the quality of the company, nature of the industry, goes up a lot. So that's when the risk starts. We are somewhere in the early stage of that where we're starting to see that happen.
All right. Hi, Venu. Good morning. Nigel on this side. Venu, I wanted to ask you about, we focus more on the PE and the multiple out there, but cash flows have improved as well. In the last few years, balance sheets are in far better shape as well. So give us a couple of numbers out there in terms of an improvement, particularly on the free cash flows. Yeah.
So, Nigel, I guess you're right. I mean, it's an important point you've raised around free cash flows and how critical it is for the evaluation of any equity market. And more importantly, you're right, one always tends to look at price to earnings, but the reality is what happens below E, which is how is your operating cash, how is your working capital, and how much have you funded from a capex point of view to get that sort of earnings growth are more very important variables for a market cycle. Now, the interesting thing is if you look at data, we looked at the top 110 odd companies. I mean, this is 150 companies. We excluded financial companies, so 110 odd stocks, which represents almost 1.5 trillion plus of market cap. So we're fairly relevant in terms of quantums. Now, the reality is that over the last 3 years, in aggregate, these stocks have generated close to about $120 billion of free cash. By the way, that is 2x of what India Inc., as I say, has generated for almost a cumulative 10-year period prior to that 3-year period. And interestingly, on an annual basis, we are like almost like 10x of what we were generating, let's say 10 years back, which is almost a $40 billion range of free cash. Now, the fundamental reality is that if you were to look at it, this is not just about IT services. We have seen a broad basing of free cash across sectors. Now, you in fact talk about auto is generating a lot of free cash, for example, and some of these, cyclical companies we used to really worry about. To that extent, even commodities did generate a lot of free cash in the previous, 1 or 2, even utilities, right? So to that extent, what is happening is that provides you downside protection for the market because balance sheets are in a much better shape. See, end of the day, when we talk about formalization, that has been one variable, of course, which has supported some of the companies. But there is another factor which has supported is because companies have generally been very careful about how they manage working capital, and more importantly, also very careful about capex use, right? Which is because they already had a lot of capex which they'd done earlier. This is a very important factor in my view for supporting the market. The only thing which we need to watch from here is how are companies going to now use the free cash, right? So that's a very critical variable because if they use it well and reuse it well into things which can generate productive growth, it's going to actually help the markets on a cycle basis. But if they filter away the cash flows, like we did after 2006-07, all the cash flows in that cycle were frittered away into really random activities, which is why we had a very long down cycle post that. So we need to watch out for that.
Okay. Venugopal, hi, good morning. I just want to get to your portfolio construct right now. I think what I recall from an earlier conversation somewhere in June, you were positive on some of the home improvement themes, on autos, but you were a little more cautious on consumption. So tell us, at the end of the first quarter, top down, big picture view, what are your biggest overweights where you still have conviction? For instance, I remember you like defense, but then now stocks have run up so much. And which are the areas where you're going underweight, where there's some caution coming in?
Yeah, so you're right. I mean, you're broadly right in terms of what my broader portfolio construct was earlier. Honestly, no changes until now. But the way I would look at it is that my conviction on the financial sector hasn't taken any backseat yet. And I think this is that pack of that large cap, which is still down. If you were to look at some of the frontline financial sector companies, the larger ones, they're still down YTD. So in that sense, I guess that's my largest overweight. And I'm treating it, as I mentioned earlier, not like a 6-month view, but a 3-year cycle. And that's what I want to play the financial sector for. It does make sense to basically keep buying in this situation. That's my largest overweight. Now, outside of that, if I were to look at my overweights, then sort of trickle down into smaller areas. So for example, in IT, my overweight within IT is actually consumer tech, which is something I had upgraded beginning of the year. So the consumer tech companies, some of these new economy companies which are related to food delivery or even fintech. So that's a key overweight for us within the IT sector. Autos, I'm actually neutral, in the sense that I do have some buy ideas, but I'm not looking too excited about a large amount of returns from here. And outside of autos, we still have consumption as an underweight, but we were trying to play anything linked to real estate out there, which could be pure direct real estate or an infra, right? So that is an area which we were still relatively positive on rather than pure direct consumption, which I wasn't really confident on. Honestly, nothing much has changed for me to change that view, even though inflation risks are sort of receding. Now, the only other area I would probably say that, outside of this is things like, energy or, these are or telecom. We're very, very stock specific out there. We're not really taking sectoral calls.
Got it. Okay, let me just ask you about financials, since you mentioned that is your largest overweight. And, that's a long-term view. You're taking a 3-year call. So you're the right person to ask this. Tell us a bit more. I mean, there's been selling, for instance, right now in larger banks. Everyone's complaining about margin compression. And then on the NBFC side, we are set for perhaps big disruption with Jio coming in. And since you've taken that 3-year call, tell us, A, how do you see, Jio Finance coming in the landscape and what changes there? And just overall, what is it that you're most bullish on, even within financials? If you could just narrow that down.
Okay, so, I wouldn't mention a specific name out here, but I understand your questions. I'll give you a broader perspective around this. See, my financial sector overweight to a large extent has been driven through large banks, which, of course, from a regulatory perspective are a very different, entity altogether in terms of how they approach business, and their ability to, and of course, a very different model, raising deposits and then, using that for lending. So it's a very different model altogether. So we basically have been positive on the financial sector on banks, for example, and not necessarily on things like insurance, or and from an NBFC perspective, honestly, those were trades in our view, because it's a very, very small space now, honestly. And we were, if at all, playing the other space through fintech, which is something which we like, but, we can't articulate through stocks because we don't really have coverage. Now, the way I look at it primarily is that let's look at the top-down financial sector, perspective. See, this entire perspective about NIM compression, that is, of course, a possibility, when rates sort of change, especially when cut cycle happens. And I don't think that's going to happen very quickly, though. But assuming that at some point of time we'll have to go through that phase as well, right? If I were to argue that is basically a risk, that's not really a 3-year risk, right? If we were to look at it, these stocks have actually underperformed in some way, largely on that expectation. So I think that is priced in. So my thinking simply is cleaner financial sector balance sheets and the ability to lend or grow credit growth, especially for the top banks with better deposit franchises, is something which is going to be visible in terms of growth. And they're not really over the top in terms of valuations. So that's a broad context that I have on the financial sector, top down on banks. The second thing I would probably say that, look, India still has, to a large extent, room for new financial players. Stories over. If you were to think about it, when I say stories over, is a new NBFC getting created or new fintech getting created. At the end of the day, there is ample opportunity for them to lend, and the nature and the areas they would lend, of course, will be slightly different. That's another important variable. Also remember that digitization, especially the way India is approaching digitization, is going to provide more opportunities. I mean, if you were to think of volatilization, UPI, post that we think about ONDC, now we're thinking about OSEN. Now, a combination of all that does what? It basically throws in, let's say over a 3 or 5 year view, data on entities, SMEs, or small retailers who you didn't really have data to lend, right? And so what it means, even the banking sector over a period of time can do small ticket lending and reach out to a larger and wider sort of audience spectrum. Of course, cost of funding for those SMEs will also come down, but the reality is that that's basically what provides opportunities for credit growth, right? Even for the top end banks.
Venu, your last report basically talks about its title, Strategies of the Indian Government, right? And that's the thing. People, when they say they're bullish on the market even from here on, in a way, implicitly, the bet is sort of government continuity as well, political continuity as well, even though they don't sort of say that in so many words. So just wanted to, is that a big talking point when you meet investors, etc.? And any insights there? From a market perspective, there are so many stocks and sectors, right? PSUs in various categories. I mean, defense is a big area, big winner, big wealth creator, spends on infra creation, roads, and so many others. Banks, PSU banks is another big one, which are dependent on policy continuity, which depends on what Delhi does. Yeah, your thoughts on these areas before the election?
Yeah, Prashant, I think after a few months, we're going to be discussing just about elections. So I think market has been sleepwalking it, pushing that, sort of discussion aside. A part of that is also because there is a broader market expectation of continuity of power, at least at the central government level. If I speak to any global investors, I have rarely come across a situation where there are major doubts. Now, of course, that could be a risk as well, that the market is actually not pricing in a change of government, right? The second fundamental reality is we've started seeing some questions, if at all, on what if there's a change of government, is there a risk, right? Very, very limited questions, if at all. Now, the reality is that if I were to put it in construct, continuity of power is very, very clearly required as far as continuity of policies are concerned. Now, historically, what we have generally seen is, whenever any change of governments have, happened, we have seen a situation where the good policies of previous governments have continued. So I'm not really worried about India then from a 10-year perspective or a 15-year perspective or a 5-year perspective. But the reality is you would have uncertainty for at least 12 to 18 months or 24 months till the time, these policies are digested, they relook at that, right? So that is going to be not so good for the markets, honestly. And I don't think we can form an opinion on that before May next year. So, that's like the unfortunate reality of what it is. And I don't think that state elections later in the year are also going to provide you any form of view on that. And we've done a lot of work on that, and we don't really think that, you losing a state basically means you lose the central government. There's enough data out there which proves otherwise. So we have to sleepwalk this, and we have to hope that this government continues in power. And if it doesn't, and there's a change of power, the first reaction, of course, from our side would also be to sell the market and then think what to do.
Okay. All right. Good chat today. Venu, thank you very much for joining in. You have a good day, and we'll look forward to the next one. That's the Bernstein view on the market, which, by the way, has